So we'll start now in another minute. Before that, quick introduction of me. I'm Abha Ban. I am Director of Organization Development with Simplicity Investing, joined a few months back. I have a stint of almost 18 years with corporates like Bajaj Group of Companies, Mahindra, and Maersk Global Service Centers. With Simplicity, now I'll be leading the client servicing certain part of business development. That's where we will move forward. But today's Niti is primarily for all our investors who start their story or journey of investing through a simple question, where do we invest? Uh, but over the time that we have realized that successful investing is not only about where we invest, but it is also about clarity, discipline, and principles that guide those decisions of investment. Now, at Simplicity, the vision that we have always driven and something that is very close to us is how do we make finance really simple for everybody so that investing is no longer seen a very complex, intimidating, or very few, it is reserved for very few kind of a process, but it becomes more accessible, understandable, and meaningful for everyone. And now that was the objective with which, and the thought that came to us is that we start our monthly webinar series, Niti. Niti is a platform where all investors, professionals, learners, especially who want to learn together with us to gain perspective about what's happening, how do we manage our behaviors around investments, finances, how do we help them drive or strengthen their decision making process and approach, and also how do we get some key insights from individuals who bring deep experience and practical wisdom in the investment word side or the wealth management side. So now with that, I request Rashmi to take over and you know s- share his wisdom. Rashmi is the Chief Executive Officer of Simplicity India Investing. He is a veteran with many years of experience. He's a CA and a CPA from the US. He worked in the US for a very long time, gained a lot of global exposure, came back to India to start Simplicity, and he has been working with a lot of individuals, changing their financial and life as well. Thank you, Rashmi, for sharing your time. Please take ahead.
Yeah. Thank you, Abba. I appreciate it. Thank you, all the members of the Simplicity team who have worked hard to set up this webinar. Now, good afternoon, everyone. I apologize for starting late by 5 minutes. And now, I'm doing this webinar from Sharjah Airport. I'm just moving from, I'd come to Dubai last week, and we are going to, I think we are going to Bahrain, and from there, we'll be coming to Pune. Uh, now, you know, uh, the world is changing. Let me put it this way. I'm sure everyone is thinking that the world is changing. Yes, the world is changing, but certain things don't change. Like, every day changes, but certain things don't change. There are always 24 hours in a day. Uh, There is the same cycle. Seasons come and go. The weather changes, but many things remain same. Same thing that happens in the economy. Economy, we feel many things are changing, and at the same time, some fundamental things don't change. So I'm going to talk about that, um, and we have how I look at the world and investments today. Um, and let's start. Right now, uh, currently, the everyone's focus is on impact of geopolitics on Indian economy. Uh, so globalization has shaken up all the countries in the world. In the initial phase of the globalization, the Western world benefited, like America, Europe, they all benefited. Now, in the second phase of globalization, countries like India and China are benefiting, and that's where Western world is got rattled a little bit, correct? And the whole world economy, they are trying to change the rules of the game, and that's where we are today. So, how India is going to navigate through, and how investments will navigate through, and what's going to happen, correct? So that I'm going to share that with you. The other thing I want to share, this is the uh, doctrine of US policy. So this policy was designed in 1971 by Henry Kissinger, and he said, uh, one second, who controls the food supply controls the people, who controls energy controls the whole continent, and who controls money can control the world. So if you look at this, today, America tried to control the energy by capturing Venezuela. We all know that. Iraq war also has become because of oil. The turmoil in Iran is also happening because of oil. They control the continent. And now the global shape up in the financial market is also happening because of the dollar domination, correct? And who control the America is dominating the world through dollar. And as that position is becoming a little shaky, the whole world is in a turmoil. But they are trying to get that dollar into uh, America is not going to give up so easy. Uh, Now, so this is the background of what's happening in the world. And this is the official policy of the US government, which was there since 1971. Henry Kissinger had drafted that, uh, and this has not changed. But now it has become more relevant with the things more coming openly. Many things they used to do behind the scene, politicians never used to talk about it, but Trump openly says about it. And that's the good part of the Trump. He says he doesn't hide his emotions or what he's playing. He plays openly. And that's a good thing. So other people can, countries can know, correct? Yeah. Now, if you go to the next slide, the other silent revolution is which is happening in the world is the demographic changes. So there are many things happening in the world today. One, geopolitical changes. Then second, demographic changes. Now, demographic changes is happening because of the longevity of the population. Health span is increasing because improvement in standard of living is changing the lifespan of human beings. And that is bringing more people into workforce, and that's also affecting, correct? Now, if for example, in 1950s and 60s, 95% people in the labor force were men. Now, today, it's, I think, 70-30 or 70-40, 60-40. Women are also competing with the man, correct? So the labor force has gone up. Also, the labor force, usually retirement age was 15. In 1950s or 60s, my age, official retirement age was 48, 50. Today, the official retirement age is 60 in India. In America, there is no retirement age. You get benefits after 65, but nobody can force you to retire. People work up to 75, 80. The whole thing has changed, correct? So there's a silent revolution taking place, and this is also affecting the world economy. Now, and the other third major impact on the world is happening through technology. The technology is a game changer. Humans, in the history of humans, human behavior doesn't change. We all have 99% follow the greed, fear, psychology. Human behavior has not changed. But humans at what we call the work culture, the way the nations work, the way the economy works, that has changed because of technology. Technology control. So I'll give you a classic example. Take Bombay Pune highway. No matter how many policemen you keep, no matter how many traffic rules, people used to drive beyond speed limit. 100 was the speed limit, but they used to drive a big car, 120, 130, and every day about 50 people used to die. They could not control. Now they put video cameras and you automatically get tickets. Suddenly you saw that the number of accidents and the number of deaths have come down to less than two or three a day, which was 50, 60 previously, correct? So the technology is a game changer, and that is changing the whole world. Today, you don't need more space, physical presence. You can work from anywhere in the world and you can communicate. In 1980s, when I passed my CA, the waiting list for telephone was 15 years. Today, you can get a mobile phone and you can talk to anywhere in the world. My telephone bills, which were 90s, were coming to 5,000 rupees a month. Today comes 500 rupees a month. So everything has become so cheap because of technology. Now, so these are the four factors. Now, I want you to look at this slide. The 50 largest companies in the world. If you look at those 50, let's focus on the top 10. Alphabet, Amazon, Broadcom, you know, Berkshire, Microsoft, Nvidia, Apple, Tesla. If you look at this top and Meta, Facebook, correct? Now, if you look at these top 10 companies, what does it come to your mind? What is your they are all from US, except for Berkshire. Everyone is in technology. What else comes? If you notice this, out of these 10 companies, 9 companies were not there in 1980. Berkshire was there. 9 companies were not there in 1980. All these 9 companies were started by 20-year or 22-year-old kids with $10,000 capital. And they started those companies using technology to solve a problem, right? And they solve the problem so nicely that today they control the world. They control the world. Now, that is the game changer. So none of these companies were started by businessmen. None of these companies were started by rich people. They were started by college kids. And they focused on the problem and they innovated that and thought out of box and created this company. And that is technology. Today, if one person from anywhere in the world can change and come on a global scene, that is the power of technology, which was not there before, correct? Which was not. So this has changed. Now, so now basically I'll come back to investments, correct? So these are the four underlying themes which are going in the world today. One is geopolitics, the second is demographic changes, third is technologies, correct? And the fourth is government policy. These four things you have to, on the background, how they relate to your investments. Now, I'll come back to the four asset classes. We have four asset classes. We all need to have all these four asset classes now. Uh, Real estate, bank deposit, stocks and mutual funds, gold and silver, right? So these are the four. Out of these four, two asset classes, real estate and gold and silver, are physical assets, and two asset classes are financial assets, stocks, mutual funds, and bank deposit. Now, they all four are required, but in what proportion? Like how? So now let's go back to the history and see what is changing here, correct? I've taken a base of 1960. If 1960, real estate was 10 rupees square feet in bank deposit used to give us 7% interest rate for last 40 years. Average interest rate is 7% for last 65 years, I'm saying that. Index, Sensex was just 25. In 1980, it was 100. So Sensex was just 25 and gold was 111 rupees per 10 gram. Today is 150, 1,50,000, correct? So this was the scenario. Of all these four asset class, how did the technology, demographic changes, geopolitics affected them? So this is a much longer time frame which has affected them. Now, if you see that this four asset class, if real estate has given 12.5% compounded return from that time, bank deposit has given 8% return, Sensex has given 14.5% return, and gold has given 11.5% return. Now, they all work in, except for bank deposit, these three asset class, real estate, Sensex, and gold, they work in different cycles. They all don't go up at the same time, but they all go up and down in different cycles. That's what we have to understand that. And if you understand that and you stick. Now, the biggest loser of all these four asset class is bank deposit. Why? Because out of this 8%, whatever interest you get, you have to pay 25% tax, average tax. So basically, your return you're getting is 6%. And inflation on an average has been 7% for the last 65 years in India. So if you take the inflation, you're getting practically zero return. And your value of your investing is coming down. So you so the first principle of investment is you should have only next 1 or 2 years of expenses in bank deposit. So if your household expense is 1 lakh rupees per month, then you can have up to maximum 24 lakh in the bank. That should be the rule number one. Looking at that, anything more than 2 years money which you're not going to use should be parked in one of these three asset classes: gold, real estate, and uh, stock market or mutual. Now, every case, if you play that way, you are safe, correct? You are safe. So this is the what has changed. Now, how do you play that, correct? Now, today, cycles. I'll share that with you. So if you understand the technology, everybody needs to understand the impact of technology on our lifestyle, on our investments, on our professional life, work, everything. That is the key thing we have to understand. Then you have to understand demographic changes, how aging of the population is moving the world, spending habits is moving the world. Then you get global trends. Then you get geopolitics. This four, if I have to give a weight, I would give 100% weight to technology, 75% weight to demographic changes, 60% weight to global trends, understanding, correct? Geopolitics has only 20% weight on my investment. It has a, and all these WhatsApp messages and, you know, that's minus 20 news. Because, but in reality, what's happening, we call it herd mentality. Today, 3 years back, nobody was buying gold. Nobody was buying silver. Today, everybody wants to buy silver and gold. Why? Because of this media, social media, herd mentality. Today, so that in reality that happens. How many people think from long-term perspective? Very few, correct? So, but this is the reality. That's how that's why we see the volatility in all the prices of all the asset classes, and they move in different cycles. But in long term, if you take, they will move in the same way which I showed you that uh, I showed you here, correct? In the long term, if you take 5 years and 10 years, you will see the same returns. You will see the same. This is a long term average. This is the long term average. This will continue. This is not going to change. This is not going to change. Hmm? Gold, yeah. Now, but short term, it will fluctuate because of this. Now, currently, everybody's okay. In India, dollar is appreciating, but globally, dollar is depreciating because people, because China, India, Japan, they are all selling US treasuries and buying gold and silver. That was the trend for last 2 years. And that's why gold and silver went up and dollar went down and US interest rates went up. Right? And that's why dollar was weak. Now, I think that trend has gone to an extreme. It will stop somewhere here. And again, gold prices and silver prices will stabilize for a few years. It won't go, it will fluctuate plus minus 20% from the current level, uh, but it won't go beyond that. Like it moved 200% in last 2 years or 100% in last 6 months. That kind of volatility is not going to be. Hmm? It may chances are there that it may drop a little bit more, but it won't go up 100% or 50% from current level. So this is so as far as India is concerned, the rupee dollar rate, the dollar which was appreciating will stabilize here and rupee will start appreciating now with all this kind of stuff. Because in last 1 year, India had a net outflow of money in portfolio investment and there was practical zero FDI. Foreign direct investments didn't come. Now you will see a lot of investments coming and you'll also see investments coming in the stock market. So rupee is likely to appreciate from current level 91, it can come down to 87, 86, or even 85 in a year's time. But in a short term, it will be between 81 and 91. That 88 and 91, sorry. Now, now gold and silver is a hedge when there is a global turmoil, correct? But do you think this global turmoil is going to explode? No, we are not going to see that. Uh, if you watch the news 24/7, you'll feel that the world is exploding. But in reality, no, uh, it's not going to happen like what happened in the World War II or what happened in 1930. It's not going to happen that way. So now gold and silver, which was hedged against the global turmoil, is going to uh, come back to normal. That's what I see from current level. Now, you see, gold per se or silver does not produce, means the world population is still increasing. We have 750 billion people in the world, and it's going to 800 billion, uh, 800 crores, correct? So we still need to eat food, we need to still travel, we need to buy clothes, we need to consume and all that. So those goods and services production is going to continue. Gold doesn't produce that. It saves the value. But the economy is going to grow. So when economy grows, the stock market grows. So that no trend is going to happen again back again. Uh, the metal super cycle which was there, I think it will slow down. But the companies which are manufacturing, the companies like manufacturing companies, uh, commodities companies, their stock prices will do well. Hmm? Uh, because it's very difficult to set up a steel plant or copper plant or aluminum plant overnight. And as deglobalization, the world is getting divided into three different parts. One is the Western world, one is the Chinese economy and that part of the world, and one is independent countries like India who are playing neutral to both the sides, correct? So the world is, so there are three uh, different parts of the world, and each part now is trying to hedge and protect itself. So you will see all these companies, local manufacturing going up, and manufacturing sector doing well in this thing. Now, India has entered into this is again a medium term. Uh, every country is negotiating. The good thing about what Trump did, it woken up so many countries. It woke up India. Now, Indian politicians were more focused on local politics than global politics. Now, because of Trump, India is more focused on global politics than local politics. So that's a very good change for India's perspective. Um, so India is going to more focus globally uh, on global trends, Indian bureaucrats, Indian government, everything. And that's a very good development. Indian, we all are more interested in how we deal with Europe, how we deal with Middle East, how we deal with China, how we deal with America, and all those kind of steps are happening. And Indian population is getting also more globalized. So this is a very good development uh, for the development of India. And we'll see uh, now as India, US, this is all short term, correct? Uh, Technology, if you look at this today, anywhere in the world you go, the technology engineers or software or hardware engineers or management people, they are all Indians everywhere, correct? So India exports, even companies like TCS, Infosys, though they have a 52-week low today, they are going to do well. That cycle is down now, but they are going to do well. I won't write them off. So, in fact, yesterday, the Dow crossed first time 50,000, correct? In spite of this global turmoil. You will see Indian stock market is not at 52-week high. You will see next 30 days or 60 days, India also hitting the new all-time high. Indian stock market also will do that. So we move in cycles. So the we'll see that happening, and you'll see this time there'll be a much more broad-based rally in the stock market too. Hmm. Now, I'll go to the oil, correct? Now, the good thing about India, I'm talking only from India's perspective, in spite of this global turmoil, oil prices have not shut down. We are shot up. A few years back, we had seen oil at $140 a barrel. Today it is $60 a barrel. And India's dependence on oil has come down. So when Indian economy was $1 trillion, India's GDP, India used to consume 1 lakh barrels per day. Today, India's economy is $4.5 trillion GDP, but India is consuming only 1 lakh 80,000 barrels a day. So economy has gone up 4 times, but oil consumption has gone up by 80%. So we are less dependent on oil now, and we have more other green energy sources. So India is becoming slowly, it is not fully self-reliant today as far as oil is concerned, but it is becoming less dependent on oil and more dependent on other energy sources. So which is good, which is good. Um, and we will see uh, a positive effect of this on the Indian stock market in the, uh, going forward, correct? And as far as Trump economic is concerned, uh, the good thing about Trump is he has shaken up the world, and he he talks openly. Now, many times we find him crazy. Uh, Nobody can predict what he's going to say next. But if you look at underlying long-term stuff, if you look at his first term, if you look at his first term, he did all what he said. Now you look at the second term, he's also continuing that same trend. Now, I'm not trying to judge him whether he's good or bad, but there is a rationale behind what America was lagging behind compared to China in a lot of fields. Now they have woken up for that, and he's shaking up the country, and which is not a bad thing. Which is not a bad thing. Also, there was a lot of illegal immigrations happening in America, so which is now going to have affected that. Now, in short term, when you make any changes, uh, it affects everyone. So, this immigration policies, though may sound crazy for short term, but for long term, it's a rational. Uh, uh, Sanity will prevail. People who want to do legal stuff, uh, shouldn't have any problem. Uh, America is still going to have immigrants. America is going to still invite talented people. So that won't be a problem. Uh, and India is going to benefit from that. India is going to benefit from that. Now, as regards the US economy is concerned, Trump wants interest rates to come down. America has a lot of debt. But how much is that debt? America's debt is equal to its 1 year's GDP. America has a debt of $35 trillion. Its GDP is 30 trillion, $32 trillion. So 1 year's GDP is its debt. Now, is it that bad? No. Japan has a debt to GDP ratio of 2. Europe has much higher than that, 1.5 than America. So still America is reasoning. But what is happening is, since it's the largest creditor in the world, the focus is there on them. Now, still, with all this new innovation, all these strategies, the debt, that's why US wants the interest rates to be lower so it can service the debt. So we'll see a little bit turmoil there. I do not see interest rates going down much. In India also, the interest rates are at the bottom. Interest rates will go up slightly over a period of next 2, 3 years. As interest rates go up, all old economy stocks, all old brick and mortar stocks will do well. Physical assets will do well. Uh, so we'll see that happening uh, in the near future, correct? Yeah. Now, today, India's GDP is growing at, so I'll just give you a different, India's GDP is $4.5 trillion. Uh, Now, if you take 8% of that, so it is almost adding about $400 billion a year. Hmm? India is adding to its GDP when it's growing at 8%, adding at 8, 8%, it's adding $400 billion per year. Pakistan's GDP is $350 billion. So we are adding one Pakistan every year. Imagine that the growth we are having. Now, if we look at America's GDP is 35 trillion, let's say $30 trillion to make it simple case. Now they are growing at 2% or 3%. Let's assume 2% at 300 $30 trillion is adding 60 billion, $600 billion every year. It's adding $600 billion every year. At 3%, it's adding almost $1 trillion every year. So still the growth is there in US. So the growth is there, which we should not, just because we say it's 2% growth and India is growing at 8%, the absolute amount of growth still is higher in America compared to India. We have to understand because the base is very large. India's base is low as compared to US, correct? So we need to understand that the growth is there. Now, coming back to your uh, sectors to watch. So before that, I'll ask, if today, let's say every Indian, every investor need to have all four asset classes in his portfolio, which is have to have 2 years expenses in bank deposit, uh, has to have 10% in gold and silver, has to have 25% in real estate, and balance in stocks and uh, mutual funds, long term, correct? Now, in stocks and mutual funds, every Indian should have 80% in India, 20% in dollars, outside India. If you are living in America, 80% in American, 20% in Indian. Now, I was in Dubai here. I met a lot of investors here. They have 50-50. They have 50% assets in India, 50% assets in US dollars. So everybody should have the portfolio that is strategically aligned based on where they want to be. Now, currently today, if I'm looking at India, which are the sectors which are going to grow? Banking and financial services sector, capital goods, and IT services. These are the sectors. Now, banking and financial services did very well last 1 year. They are going to continue to grow, but the growth is going to happen outside banking and financial banks. Growth is going to happen in mutual fund industry, wealth management industry, insurance, uh, stock broking. So financial services include banks plus so many other credit card, housing loan. The growth is going to happen in the other sectors, right? Now, in infrastructure and capital goods, you'll see growth happening in engineering sector much higher, commodity sector much higher, like steel, cement, paints, machinery. You'll see those some of those stocks have given mediocre return in the last 15 years, but they are going to grow at much faster rate in the coming few years. In IT services, also you'll see growth. Now, Infosys and TCS, those big companies, what's going to happen because of AI disruption? They will lay off a lot of people in the middle management and top management. But their revenues are not going to come down. They see AI is not going to replace human decision making. AI is not going to replace that. Human decision making is still required. Now, like when computers came, stenographers' job went off. Because previously, I used to have stenographers used to take dictation. But with Word, Microsoft, Windows coming, I type myself, correct? I don't need a stenographer. The same thing is going to happen with AI coming. A lot of routine jobs, middle management jobs are going to go, but there are going to be more different kinds of jobs, intellectual jobs, how to read data, how to analyze data, how to take a decision. Those kind of jobs are going to be there. Uh, so the economy is going to change from that perspective. Uh, Big IT companies are not going anywhere. Software companies are not going anywhere. They are going to though they are just now currently at close to 52-week low, they are going to bounce back sharply. So this is uh, my take. Now, market volatility is going to continue. Now, when market is volatile, you should not get afraid. Like, our moods don't go up always. They go up and down. Same way weather goes up and down. Same way markets go up and down. You have to take advantage of that volatility where what is down, you invest, what is up, you book profit. And that's what you do. So today means, when silver and gold was at 2 weeks back, 52-week high, I recommended many people to clients to sell silver and gold. And in fact, in Simplicity Treasury also we sold silver and gold. And we bought what was at 52-week low. Uh, so you have to take advantage of that. And that is very important. Market volatility is this is how you grow your portfolio. Now, the other thing, follow a process. Uh, the world is changing, but the days still remain 24 hours, correct? The- We still eat breakfast, lunch at the same time. So many things don't change. The same that we call it systematic investments also. A systematic process has to be followed. Certain things don't change, and that's how you reduce the impact of volatility and take benefit of it. That should continue. Uh, there is going to be and today what's happening is volatility is there. Too many WhatsApp messages, too many gossip happens in social circles, do not get affected by that. Stay focused. Your strategy should not change. Your strategy of building wealth and your investment should not change every day, every week, every month. It should not change. In fact, Simplicity strategy has not changed for last 12 years. We have continuously followed the same strategy, same sectors. The sectors which are down, we invest more. Sectors which are going up, we book profit. When the client wants to redeem the money, we redeem from the funds which are doing very well. We put money where funds which are not doing well. People do reverse, correct? What they do, they take out money from what is going down and they change what is going up. You that doing that is very dangerous to your health, or financial health. Don't do that. You should be doing reverse. Uh, and this kind of volatility is going to continue. I'm telling you, there is going to be news every day because there is 100 crores people living in the world. There are good things and bad things going to happen every day. There is going to be geopolitics. Elections are going to be there. There are going to be small fights. All that thing is going to continue. The world is still going to progress. Uh, so what you need to do, have a proper asset allocation, proper equity portfolio, and the equity portfolio should consist of global. Uh, do not shuffle your portfolio based on returns. Uh, your portfolio should be balanced based on strategy, and that should continue. Uh, I stop my presentation here. I would like to take questions. Uh, please post your questions. I'll be glad to answer them. Uh, See, the other thing which I have noticed, um, I meet a lot of clients, correct? Clients from India, abroad, different segments of the society. One pattern I see, clients who do not shuffle their portfolio over a period of time, they do very well. They do very well. Clients who keep on, like when you're driving, you keep on changing the lanes. What happens? Do you think when you keep on changing the lanes, you're going faster? No. You're wasting energy and taking stress. You're not enjoying the ride. If if you're sticking to the lane and driving, the driving is peaceful. You reach on time. There's less stress, less probability of having accidents. But same thing has investment. Don't keep changing your strategies or based on news or emotions. So focus on your that. Yeah. Uh, Shonit, do I have questions? Please guide me. I
Uh,
think yeah,
Everybody
go
are
ahead.
free to unmute themselves. So you guys can, unmute yourselves, ask questions. We can have an open conversation here.
Yeah. Uh, I'll take the first question.
Also, you guys can post the questions on the chat if you want, if
Yeah.
you guys want.
Now, if somebody is asking, want to know which are the sectors we are going to do immediately well, I would say manufacturing, whole economy stocks, and sectors which have not done well last 2, 3 years. Uh, they are going to do well. From current rate, at today's rate, the risk reward ratio is unfavorable to gold and silver and favorable to equities. Uh, but today, everybody is talking about gold and silver. Uh, so I say where there is noise, stay away from it.
Um, Hi, this is Girish.
Yeah, hi Girish. Yeah. Mhm.
Hi. Um, I was curious about healthcare.
Uh-huh.
I mean, what's your
Very
outlook for
good.
healthcare?
Yeah, very good. So healthcare is a steady sector, correct? It's not a volatile sector like infrastructure, or it's not a volatile sector like IT or gold. Healthcare is a very capital intensive sector. To set up a hospital or to set up a pharmaceutical company. So you will see a gradual growth. But if you invest and look at today in healthcare and you look after 5 years, it will give you a compounded 15 to 20% return. Healthcare doesn't. Healthcare is not a volatile sector. It's a defensive sector. It gradually grows, but it grows. Uh, Now, you may see one or two pharmaceutical companies growing very fast if they discover new drugs or something like that. But otherwise, healthcare is a steady sector. It grows at a steady pace, like FMCG sector. It's a and we call it a defensive sector. It's less volatile, and but from today to 5 years down the line, healthcare sector will grow by 20% per annum. You will get that growth. Today in India also, healthcare, the hospitals are only in big metro cities. Good hospitals are not there in small towns. Now everywhere, healthcare is getting corporatized, which was not there before 20 years back or 10 years. So big hospitals are coming everywhere. It requires large investments. Then awareness is also becoming. And as population ages, more spending happens on healthcare. And senior citizens have more money to spend on healthcare than youngsters. So healthcare expenditure as a percentage of GDP is going to go up. And in India, and India also exports healthcare services. So we should be doing well there. That should be a core of your portfolio. But it is not a, see, investors like what is moving every day up and down. If that's not going to happen there, it's going to go steady. Just invest through SIPs and build in that sector. Yeah. I hope I answered it. Hmm? And
Yes, yes, thank you.
yeah, thank you. Thank you, Girish.
There's a question from Lakshmi. Please, once
Hmm.
again, the percentage of portfolio in the four branches. What should be the ideal percentage in those four asset classes?
Idle percentage should be depending on your age, but you so I would put it this way: at any age, 25% should be in equity. Now, if you're young, it should be higher. Uh, if your portfolio is very large, equity can be higher. So it depends on the age sector. Now, to play safe, the most conservative way to play safe is having 2 years expenses in bank deposit. 2 years. So your expenses you multiply by whatever it is, keep it in a bank deposit for this. Then other than that, uh, your house should be not more than your 4 years family income. So if your value of your house, so where you're staying, so if you're in earning 1 lakh, or sorry, if you're earning 25 lakh rupees a year, your family is earning, your flat where you're staying should be 1 crore maximum. So that will be a balance. If you're earning 50 lakhs, your flat should be of 2 crores. Uh, so like you work for 40 years, out of 40 years you're earning, 4 years of earning should go in your real estate for where you want to stay. Now, real estate for investments, uh, it should not cross of your total portfolio. Should your house and your real estate for investment should not be more than 30% of your wealth, net wealth. So it should not be more than 30% of your wealth. Now, gold and silver should be 10% of your net wealth. So if your financial assets are, or your net wealth is 2 crores, 10% of 2 crores is 20 lakhs. Should be in gold and silver. Hmm? And that's how it should be. Now, if your portfolio is 10 crore, gold and silver can be less than 10%. It can be about 5%. It's okay, 5 to 10. Now, as regards your financial asset portfolio, 20% should be in dollars, 80% should be in rupees. Now, it depends. If your children are living abroad, then it should be higher. So, in case, so that's how the structuring should happen. It should be done based on your profiling that we do individual profiling. There is no standard for everyone, one standard for everyone. It doesn't fit, correct? It depends on your financial responsibility, your needs, your lifestyle, and accordingly we structure the portfolio. Yeah, but very good question, Lakshmi. Thank you. Hmm. The next question I have: do you see lump sum investment opportunity in equity now? based on expected bull run, or are valuations likely high or better? Stick to regular SIP. No, today, if you should continue SIPs, but if you have lump sum, it's a good time to invest. Uh, it's a very good time to invest. You can invest in two lots. So if you have 2 lakh rupees, you can invest 1 lakh on Monday, and you can invest another 1 lakh if market goes down by 5% or goes up by 5%. So I always tell people that do not try to time the market. So let's say now the market is uh, still market has not run up. It's a very good time to invest. So invest 50% now. If market goes down, invest balance 50%. When it goes down by 5%. If it goes up by 5%, invest the balance. It's one and the same. Yeah. Hmm? Yeah. How do you identify the right dip for the top? What is you think? Top ups, yeah. Uh, right dip means when markets correct by, okay, so let me put it this way. At any time market corrects more than 3% in a day, blindly invest. Uh, in a day, if it correct. Anytime market corrects more than 10% in the month, blindly invest. Anytime market corrects 20% in a year, yeah. So that's how we identify. But just now, the dips can be, you won't see a dip more than 1.5% or 1%. So market dipped by 1% that day, we should invest. No problem. Hmm? How do you foresee the tech AI exposure in India? So India is not in the core innovation like what Google, Apple, Microsoft are, correct? India is good in using AI, correct? So India is very good in using AI and supporting AI companies in writing AI, all that kind of stuff, correct? In maintaining AI infrastructure. So in India, I look at companies which are going to use AI in their businesses. Mm. So big companies, now who use a small jeweler or small businessman, he's not going to use technology. But companies like Asian Paints, Reliance, L&T, uh, Tata Group of companies, they are going to make better use of AI. Now, AI will be, where is the AI most easy to use? One in banking and financial services. That's the number one. The second is in traveling, correct? Hospitality industries, behavior patterns, automation, travel, correct? All that thing. So if you see most of the airports now, if you go to US or any international airport, everywhere security checking is becoming so far AI, correct? Everywhere those technologies are becoming much more efficient uh, to use invest in companies where AI is being used effectively. Uh, in India, that's going to be the game changer. The next question is it the best time to do SIP in gold and silver? Uh, yeah, but it is you should have SIP in gold, silver, but gradually you do it. If you didn't have it, start it now, but with a small amount and gradually increase when it dips, correct? When it corrects and when it stabilizes. Now, do not chase the gold and silver. Now, as I said, the upside is less, downside is high today. So probability of it going up is 20-30%. Probability of going down is 70%. Whereas in stocks, it's reverse. Probability of stocks going up is 70-80%. Going down is 20%. So inversely, yeah. So go gradually there. How is the IT sector in India likely to perform in the coming years in view of the global conditions and AI automation impacting the execution of this? So IT sector it will, IT companies will change. So if you see Infosys from 1994 till today, Infosys, PCS, they have changed. Their software services, their client base has changed. They have gone in engineering, they have gone more solution oriented. They are going to develop more products. So that change is going to continue. IT is a part and parcel of life, and those companies will continue to do well. They are not going to vanish. They are going to grow. They are going to be profitable. So today, if you see TCS and Infosys, the dividend yield on that stock is 3%. 3% is the dividend yield. They are very good at this juncture. Now, there are companies, digital companies. Then IT companies, there are two kinds of companies. One is software services, one is digital companies, correct? Which consumer facing like Zomato, Policy Bazaar. Yeah. So both will have a different growth trajectory, but both are going to do well. The valuation today supports big IT companies like Tata Elxsi, uh, Infosys, TCS. They are good. Yeah. Mhm. Now, what is the next best measure of dip Sensex Nifty? So uh, I don't see more than 2 or 3% correction in the market here. Market is oversold as far as the FFIs are concerned. I don't think there is any leverage position in Indian stock market anywhere. Hmm. So the what is the measure of dip? So the measure of dip is 1 or 2% in a day. As I said, percentage dip, correct? Hmm. Yeah, Sensex or Nifty, correct? 1 or 2%. Yeah, 1 or 2% dip, it should be okay. If it dips by 1 or 2%, invest on that day. Mhm. The technology fund, infrastructure fund, and defense fund is not doing good for some time now. Is there a need to relook for the portfolio? No. So let me say I have 4 children, uh, or you have a cricket team of 10 by 11 players. Every player doesn't hit century everywhere, but you have a team, correct? All these sectors are a team in your portfolio. They work in rotation. So now in next bull run, they will be playing performing. So they know you don't have to. Uh, you have to look at any fund from minimum 5 years to 10 years. If a fund doesn't perform beyond 5 years, then there is a problem. But you can't judge a fund from 1 year or 2 years perspective. It's very dangerous. Uh, Minimum uh, benchmark should be 5 years to evaluate a fund. Yeah. Mhm. Sector. Now, technology sector, you see, every sector has a different cycle. Technology sector has an up and down cycle of 2 years, whereas the infrastructure cycle goes for 10 years or 15 years. 10 years. Uh, so you have to evaluate from that perspective. Hmm. The minimum you should give 5 years to any sector, to any fund. Yeah. But they are the core sectors. Those sectors are not going to vanish. And none of this India infrastructure is the key, correct? Uh, yeah. Uh, I think most of any more questions? Otherwise, we'll wind up. I appreciate everyone joining on a Saturday afternoon, and do share feedback with us how we can improve this and what more topics you want will come up. Uh, I can talk on more specific things. Now, one of the other things, as Simplicity's clientele is a global clientele, we have clients from different parts of the world. I see the portfolios, I see the thinking. Uh, so, uh, I'll just share. I met 2 clients uh, recently, both in the same country, I mean abroad. One client had India focus, 100% portfolio. Other client had 100% 95%, 90% focus on US, 10% focus on India. The gentleman who had a US focus, his portfolio did very well. Uh, so what I'm trying to tell you is you need to be balanced. And I've seen the difference. Uh, you need to have a balance in your portfolio and not get emotionally attached to certain things. Yeah. Logical thinking. Yeah. With that, I have sorry, I'll wind up my today's session. Thank you very much.
Hello, sir.
Yeah.
We have one more
Yeah.
question.
Yeah. Yeah. Can
So,
you give some
how many
remark
times
on in
the thematic fund?
ICICI thematic fund? Yeah. So the advantage of thematic fund is, so let me, very good question. Very good question. Uh, so let's say you are investing in three sectors, five, let's say we are investing in five sectors. One is infrastructure, one is banking, one is gold, uh, and then one is US, and one is consumption, correct? And you want to move money from one fund to another, rebalance the portfolio. When you rebalance the portfolio individually in these funds, you will have to pay income tax because from the capital. But when thematic fund does rebalancing, there is no income tax because it's within the fund, it's rebalancing. So thematic fund, like, what is the difference between a mutual fund and investing directly in stocks? When you, let's say, I'll give you an example. If you buy, let's say, an investor buys 1 lakh of Titan shares, and mutual fund also buys 1 lakh rupees of Titan shares. That 1 lakh becomes 5 lakhs. So individual also sells Titan shares, and the mutual fund also sells Titan shares. So there's a 4 lakh profit. Now, when there's a 4 lakh profit, the individual has to pay 12.5% tax on that. So he pays 50 per thousand income tax, long-term tax. The mutual fund doesn't pay any tax. The mutual fund will reinvest that 5 lakhs in other stock. The individual will be able to invest only 4.5 lakhs in the other stock. So there is a cash outflow. In mutual fund, the outflow happens when the investor leaves the mutual fund. Same logic goes in thematic funds. So let's say you invested in banking fund. That banking fund gave you 40%. Last year it has given 20, but I'm just for example, it gave 40%. So you think it has outperformed the market. Next year it's not going to underperform. So you want to book 20% profit in banking. Now, when you book that 20% profit on banking fund, there will be long-term capital. But if the same banking fund was a part of thematic fund and they rebalance that portfolio, there is no income tax. And that is the advantage. The only disadvantage of thematic fund has an income tax, long-term capital gains of 24 months holding period, whereas a individual mutual fund has a holding period of 12 months. So for any investments for a very long term you want to do, thematic fund is a better option. Then, yeah. So 1 or 2 years, correct? If you're investing for 5 years or 10 years, then thematic fund is a better option. It's a more cost efficient. It's more, now you may see less volatility. Also, the volatility in thematic fund is much lesser than your individual portfolio. Thematic fund also does regular rebalancing, which happens automatically, whereas in individually we have to do sometimes. Yeah, it's a manual process. Yeah. Uh, but whoever asked this question was a very good question. Thank you for that. With that, I end my today's session. Thank you.
Thank you everyone for
Yeah.
joining. We'll be doing this every month. So hope to see you guys again next month and we'll try to make this more engaging next time. Thank you so much. Very good questions and wonderful session. Thank you.